Now friends, let me discuss some of the provisions with respect to depreciation provision. In fact, the major discussion in this particular part is the depreciation only. However, not much of the discussion required with respect to the repairs expenditure. Basically, three sections. One is section 30-31. Okay. Section 30-31 basically says that where there is any assets which are used for the purpose of business and profession, if there is any repairs, maintenance kind of an expenditure, then you will get a deduction under this particular provisions. Not much to discuss. And as you know, the concept of revenue, capital and all basic concepts equally are applicable under this particular provisions. Section 32, which is the depreciation provisions from the income tax point of view, and let me tell you that income tax has a very unique method and very unique way of giving you deduction on account of depreciation. See, you might not have studied this particular method anywhere with respect to depreciation, because it's a very unique method with respect to the depreciation. Now, section 32, you understand the hardcore basics, and when you will solve the detailed questions, you will be able to understand that even much better. Okay. Now, see, first of all, section 32, which talks about a depreciation. Under income tax, you will get depreciation on the block of asset. First of all, you understand it is a depreciation on the block of asset, and the block with respect to building, plant and machinery, furniture and fixture, and the intangible assets. Okay. And you have to group the assets. Okay. So first of all, you have to create a block. That means you have to group the assets, and the grouping will be done with respect to the class of assets. Supposing building, so the building will be a separate group, plant and machinery will be a separate group, and like that. Okay. And supposing in the building there are two types of buildings. Supposing one is eligible for 10% depreciation, another is supposing eligible for 20% depreciation. So this will be your one block. Okay, and this will be your another block. Okay, so you have to keep on adding the assets into the block of assets, and on the block of asset, which is a group of asset basically, okay, you will be eligible for the purpose of depreciation. Okay, so on the group of asset you will get it. Okay, and you will have to compute in a special method that I will explain to you in just some time to go. The basic condition is you should be the owner of the asset, and you should be the user of the asset. Okay, two strong condition: ownership and the usage. Usage, naturally that it should be with respect to the business and profession of the assessee. So supposing if it is used for the personal purposes, you will not be eligible for the purpose of any depreciation. Now, there are many judgments on this. Ownership can be of two types. One is registered, other is beneficial. For example, a motor car registered in the name of the partner, but actually it is owned by the partnership firm. Okay, so the registered ownership is with the partner, but the beneficial ownership is with the partnership firm. So both the types of owners will be eligible for the purpose of depreciation. However, double depreciation you should never think. Okay, so put it differently, the beneficial owner in the given situation, who is actually the user for the purpose of business and profession, will be eligible for the purpose of depreciation. The usage can be of two types, active and passive. In other words, active use, for example, the motor car when you are actually driving on the road, and passive maybe when it has been sent to some repair, maintenance or something like that. In other words, the usage or the user of the asset should be understood as very broad. Okay, when it comes to the, in the very broad sense, in the very broad manner, that even a passive use will be eligible for the purpose of depreciation. Okay, then every depreciation you get it at full rate or half rate. Okay, you get either a full rate depreciation or get a half rate depreciation. Now, under income tax, there is no need for you to do that, day-wise, month-wise calculations, nothing like that. So, on the group of asset, if there is any asset, any particular asset, now if it is used for less than 180 days, then you have to make it half the rate. Otherwise, that asset will be eligible for the full rate. And logically, this half rate, full rate will be applicable only in the first year of the asset acquisition. And once the asset forms part of the block of asset, then it is okay. Then all the subsequent year, you will be eligible for the purpose of depreciation, logically the full rate. Okay. Then on some of the specified assets, you are also eligible for additional depreciation. And this additional depreciation is sort of an incentive, okay, which has been given by the government, and the additional depreciation will also be reduced from the block of asset, but it is conditional that with the condition you will be eligible. Okay. Now, from the Finance Act 2021 and onwards, that means assessment year 22, 23 and onwards, okay, if there is any intangible asset, okay, which is a goodwill of the business, okay, will not be eligible for the purpose of depreciation. Now, technically, if you will see the definition of the intangible asset, it says a trademark, know-how, copyright, patents, like that it is saying, okay. In other words, if there is any goodwill of the business, okay, will not be eligible for intangible asset depreciation, okay. However, let me tell you logically, okay. For example, you may say copyright, patents, know-how, okay. These are all types of the intangible asset which is defined, and it is going to exclude the goodwill of the business. But logically, this patent is one type of goodwill only. Know-how is one type of goodwill only. Logically, all these intangible asset is one type of goodwill only. But the goodwill of the business is specifically been not allowed. I repeat, specifically been not allowed for the purpose of depreciation. Let me tell you one very logical thing. However, the law is not clear on this point. But one logical thing, that if it is a goodwill, for which you have paid a price, law is not clear on this point, but when we solve the questions at the respective places, we will take care of this particular concept time and again. If it is acquired goodwill by paying a price, okay, then you will get a depreciation on that. Is a view. It is a debatable view, but it is a view, okay. However, if it is not acquired goodwill, then you will not be eligible for the purpose of depreciation. That is absolutely clear, okay. So, this is one goodwill point which is brought into the record by the Finance Act from the assessment year 22-23 and onwards, okay. The depreciation has to be calculated in this particular manner, okay. First of all, you have to group all the assets, okay. You will have an opening WDV. To the opening WDV, you have to add the actual cost. So, add, but here you will add all the asset. Now, for example, if you say asset number 1, 2, 3, supposing building, if I am talking, okay, if supposing during the year you purchase 5 buildings, then all the 5 you have to add, okay, but what you have to add is the actual cost, okay. Then, if there is any building which you have sold, anything which you have sold, okay, that you have to reduce it. Now, when you say you have to reduce it, it is the entire sale price that you have to reduce it, okay. So, in the books of accounts, what to do, that supposing one asset, okay, suppose, okay, in the books of accounts, supposing the cost was 10, so far you claim the depreciation 6, so as per books of accounts, the cost is 4. Now, if your selling price is 5, okay, then in your books of accounts, you will have a profit and loss of 1. This will be in the books of accounts when you will sell for 5, okay. This will happen in the books of accounts, but it will not so happen in the income tax. In the income tax, the entire sale price you have to reduce it, okay. So, logically, if you say the entire block, it is like total cost added over a period and the total sale price subtracted, and on the adjusted figure, which you call it as a WDV, you have to calculate a depreciation, okay. And on this, if there is any additional depreciation, give the additional depreciation. If you are entitled to, not entitled to, then don't give the depreciation, additional depreciation. Normal depreciation you will get it, and thereafter you will get a closing WDV, okay. So, individual asset when you are selling, there is no taxable profit or taxable loss logically, okay, in the income tax. However, in the books of accounts, every single asset transaction, you will give a profit or loss, okay. But one fine day, see what will happen is in the income tax, one fine day, okay, because I'm just telling you imagination from the multiple year point of view, because so many years when you have done the business, you have added the actual cost and you have subtracted the selling price, okay. Now, one fine year, what will happen is your selling price will become so huge, okay, that this WDV figure is going to become a negative figure, because the sale price is very huge. For example, opening is 10, addition is 20, and the sale price is supposing 100. Then your WDV will become straight away negative figure, okay. Then you will get confused. So, this will be the year where you are getting excess over your cost logically. you will have a profit, a taxable profit. Okay, and that taxable profit will be governed by section 50, and this particular section 50 will say that this will be your deemed to be a short-term capital gains. Okay, deemed to be short-term capital gains. This is how it is going to happen. Okay, and this is the only year when there will be a taxable profit. Okay, and the block will continue in the subsequent year. If there are assets, then it will be continue at a zero value from the subsequent year on onwards. Now there are subsequent year, again you make the addition, again you add, and thereafter if you sell, you less. Okay, the same methodology will continue. Now there is another situation which can happen from the income tax point of view is, for example, your opening is 10, addition is 20, but if your sale price is, say for example 12, okay, but you are sold all the assets into this particular block. So your total cost was supposing 30, but now you sold it for 12. But what happened is that you have sold all the assets into this block. That means the block is practically empty. So there is actually no usage of the asset. There is no usage of the asset because there is no asset in this particular block. So in this particular year, whatever is the difference, you will get a loss. Okay, you will get a loss if your sale price is a lesser figure. But when the block becomes empty in terms of the asset, this is again governed by section 50, and this loss will again be deemed to be a short-term capital loss. This is the methodology in which you have to keep on computing. You have to consider every separate block separately, and with respect to every block that you will have to do this particular computation. Okay, now let me give you some basic example first of all on this particular front, and some very technical thing that I will discuss it afterwards. Okay, now see, okay, let me give you one example first of all. Okay, now see, in this particular situation, how you calculate and all that, that word is pretty simple. I mean, I don't think so that you will have any complications here, but let us do it. Okay, supposing this is all illustrative figures. Okay, so use your calculator. Your opening WDV you have added. Okay, now when you are adding, logically this is the first year of the asset entering into the block. So in the first year only that half rate, full rate and all that issues will come into picture. Okay, so you have added two assets to this plant and machinery, and this machine has been used only for 60 days. Okay, so this particular asset is eligible for half the rate. This is eligible for half the rate. Okay, and any other asset is eligible for full the rate. Okay, then during the year you have sold something also. Okay, and this is your WDV. Now see what you have to do logically, think properly, because otherwise you may do some mistakes here. Now this is your WDV. You have to give a depreciation. You have to give a depreciation on the WDV. Okay, so out of this 9,50,000, okay, you have to remove the asset which are eligible for half the rate, because what is eligible is only 9,50,000. So 3 lakhs is eligible for half the rate, and the balancing figure, if any, I repeat, the balancing figure, if any, okay, will be eligible for full rate. Okay, so logically, and when you follow this method, you will go right when it comes to the computation. Otherwise, these depreciation provisions are very bulky. You know, when you will do it from the back, it is going to become a lot of theory reading on this particular front. But once you understand this, it will be absolutely fine. Okay, so if you see the working, first of all, what I have done. Okay, this 9,50,000 is eligible for depreciation, or WDV is eligible for depreciation. Okay, so first you exclude whatever is for the half the rate. Okay, so percentage is 15%. Okay, but you make it as half the rate. Okay, so just use your calculator. Okay, so your depreciation is 22,500 by half the rate. Okay, this is a normal depreciation. Now the balance figure you calculate full rate. Okay, so this is your depreciation. Now if these asset, that is machine number 4, okay, if it is eligible for supposing additional depreciation, I mean it's a assumption, because additional depreciation also has a condition. Okay, so assuming that, because this is just a rough working, okay, that this is eligible for additional depreciation. So if the asset is eligible for additional depreciation, and if that asset is eligible for half the rate, then additional will also become half the rate. Okay, so that's a condition. Okay, so additional rate is 20%. Okay, since this asset is eligible for half the rate, for example, then you have to multiply with half the rate. Okay, and you will be able to get the additional depreciation of this particular front. Okay, so this is your normal depreciation and this is your additional depreciation. Okay, and once again let me erase this. Okay, okay, so this is your total depreciation, and the total depreciation broken up into, okay, this is your normal depreciation, this is your additional depreciation, and this is your total depreciation is just a working. Okay, now on the another block, exactly similar methodology you apply and get the amount of the depreciation on that particular front. Okay, now when it comes to the goodwill of the business, okay, goodwill of the business, let me give you one example, because from Finance Act 2021, there is a lot of amendment, there are a lot of small changes in the variety of the provisions of the, what should I say, the income tax, to give you the a restriction on the depreciation on the goodwill of the business. Okay, now first of all, the law is providing that supposing if there was any asset which was of an intangible asset which already included goodwill of the business, okay, then you have to exclude that particular asset first of all from the assessment year 22, 23 and onwards. So how do you do that particular working? But small tiny practical amendment, but I'm not going into the technical aspect. Understand the working and things will become very simple. Okay, so I assume a block of asset. This is my year number 1, okay, year number 2, year number 3. Okay, this is the year when the transition took place, supposing. Okay, so you had a goodwill. Okay, so in the olden old years, there was no such restriction, so you claimed a depreciation on that. Okay, so you got a depreciation on that. Intangible asset is 25%. Okay, you got a depreciation. Then you got a opening WDV. In the next year, you sold some of the intangible asset. Then you got a adjusted WDV. Then there is a depreciation on that. Just multiply the percentage, you will get the answer, and you have a closing WDV. Okay, then you become opening WDV. Now, in the current year, the law says that you have to assume that if this asset was the only asset in the block of assets, supposing, okay, and you have to calculate what is a WDV of this goodwill of the business which is not entitled for the depreciation henceforward, and what is its probable WDV, that you have to exclude it from the block. Okay, so supposing, see a goodwill, if I say 100, okay, then 1 year depreciation, assuming that this is the only asset in the block, 2nd year depreciation. Okay, thereafter in the 3rd year, whatever is my opening WDV, assuming that this is the only asset in the block of asset, okay, and this is total depreciation, and this is my WDV value for the 3rd year, logically, which is included in the opening WDV of the 3rd year. So that much adjustment I have to exclude it here. So to that extent, I have to reduce my WDV. To that extent, and to that extent, I will not be eligible for the depreciation on this particular goodwill. Okay, this is what I have to do, this particular adjustment. Okay, however, okay, if this particular figure is more than the opening WDV, because if my opening WDV for the 3rd year is how much, some 82 an odd figure. Okay, so if it was more than that, then it will be restricted to the opening WDV. That means by doing this particular adjustment, you cannot make the block as a negative figure, is a amendment, variety of the small amendments, but I'm not going into the technical aspect. Okay, so the another example in a exactly similar basis, just see. Okay, see, first year you have added the assets into the intangible asset block, 1st year depreciation, closing WDV, then opening WDV. Okay, then 2nd year you have sold 80 here. Okay, so this is the change in number for illustrative purpose. Okay, your WDV, on that you get a depreciation. Now this is 3rd year opening WDV. Okay, now your WDV of the goodwill, which is logically the opening WDV of the 3rd year, logically work out to 56.25. Okay, so 1st year depreciation, 2nd year depreciation, total depreciation, and the WDV value. Okay, so if I say 56.25, if I exclude it, then my block will become a negative figure. So it will be restricted to the opening WDV. Okay, this is one special adjustment which I have to carry out, and the value of this block for the current year in this particular example will become as a nil figure. Okay, now this is one adjustment which one has to carry out. with respect to the depreciation. Okay. Now, some of the small things which I want to bring it to your notice, particularly with respect to the goodwill only, but one second, let me scroll, darling. Yeah, okay. Okay. Now, some of the small things. Okay. A block of asset is a group of asset which I have already explained that to you. Okay. It will also include intangible assets. Intangible assets also being a know-how, patents, copyright, trademark, license, franchise, etc., or any other business commercial rights similar in nature, not being a goodwill of the business or profession. Okay. So, goodwill of the business and profession has been excluded. But let me tell you friends, logically, if you have paid a price for a know-how, supposing logically, this is one kind of a goodwill only, logically. If you are paying a price for acquiring patents, logically, it is one kind of a goodwill, okay. But nowadays, the law intention is that goodwill of the business or profession, you will not be eligible for the purpose of depreciation. I repeat, you will not be eligible for the purpose of depreciation. Okay. However, one logical statement I am making, okay. If it is a paid goodwill, then it will be a debatable point. Okay. That if it is a paid goodwill, acquired goodwill, okay, then I will say that it should be eligible for the purpose of depreciation, because if you have acquired a goodwill, then it will be something of this type only, know-how, patent, something like this only, or it will be some sort of a commercial rights. See, okay. So, you have to identify that how this particular asset been classified from the intangible asset point of view, and thereafter you claim a proper depreciation on this particular front. Okay. So, this will be one of the point. Okay. And everywhere friends, this kind of not being a goodwill of the business, lot of what should I say, amendments have been carried out from the assessment year 22-23 onwards. See, here also this is your meaning of assets and all that, not being a goodwill of the business or the profession. Okay. So, like this, lot of what should I say, small tiny amendments which has been carried out, but the whole objective here is that the goodwill of a business or a profession should not be eligible for the purpose of depreciation. And not only that, you have to do that block adjustment also, that if in the earlier years it was already included in the block, then you have to exclude it from the block, and that particular working that I have already explained that to you some time back. For that also there are variety of the amendments in section 43(6)(c) and all that. Okay. But anyway, I am not going into the lot of technical aspect, but this adjustment you have to keep it in your back memory.